It is the 16th of January 2023. Happy New Year, everybody. My name is David Hickson, and in today's market update, we're going to be taking a look at the S&P 500. I must start by apologizing for the break in these market updates. I was not expecting to take a 3-week break from producing these market updates. I was on holiday in South Africa, and various things conspired against me recording these market updates, not least of which was the fact that the electricity provider in South Africa is unable to provide electricity to the country 24 hours a day, and so we were facing power cuts of up to 11 hours a day during the time that I was on holiday, which made recording these videos a little tricky. Thank you very much for the many messages that you sent inquiring after my well-being. I am indeed very well. So let's take a look at the S&P 500, and we're going to start again with a bit of a bigger picture because of the fact that it's been a few weeks since we last took a look at this analysis. First of all, this is the preferred analysis that we have been tracking for many months now. We have the 54-month cycle trough in March of 2020, an 18-month cycle trough at the beginning of October in 2021, and you can see that we have a 40-week cycle trough over here in June of last year, 2022, and the trough in the middle of October, according to this analysis, is a trough of 20-week magnitude. That means that we are in the final 20-week cycle of an 18-month cycle, which is expected to form a trough early this year, in March, as can be seen from this nest of lows over here. Let's speak quickly about these circles at the foot of the chart, these semicircles. This is the semicircle for the 40-week cycle. It is simply a visual representation of that cycle. You can see that the semicircles are centered over the troughs of the cycle in question. And you can see that the next 40-week cycle trough is expected according to these semicircles over here in March. However, this semicircle over here for the 18-month cycle is expected to form a trough much later in the year, as you can see over here. I received several questions about this after my previous market update video, and so I thought I would quickly explain why that is. These semicircles are based on the calculation of the recent average wavelength of the cycle in question. And the recent average wavelength is calculated by looking back 6 full waves of that cycle and calculating the average and projecting that average forwards. And so in this analysis, the 6 most recent 18-month cycles, when averaged, are projecting a very long cycle wavelength, as you can see over here. 23 months, which is very long. I'm not going to spend time in this video discussing why that is. The important thing to remember is when you see these displaced semicircles, you need to take a look at the recent average wavelengths that have been calculated and consider whether we should be focusing on that recent average wavelength or not. In my opinion, we should not focus on that long recent average wavelength for the 18-month cycle because it is looking back over a very long period of time, 6 times 18 months, of course. And so I don't take this semicircle too seriously. What is more important is the formation of this nest of lows where you can see the different cycles lining up. The nest of lows is formed, of course, by the fact that as price action forms low points in the market, we are able to identify the troughs of various cycles and project forward by the recent average wavelengths of those shorter cycles, and we get this inverted triangle or a triangle standing on one of its points. And so, according to this analysis, we are looking at price coming down into an 18-month cycle trough, probably in about March of this year. In recent market updates, and I say recent, it's been over the past several months, I've been considering a possible alternate analysis. Let's quickly take a look at that. Here is that analysis. It remains my alternate. It is not my favorite analysis. The important difference, as you can see, is that the 18-month cycle trough, according to this analysis, formed in the middle of October. I don't particularly like this analysis, but I do think it's important to continue to watch it and bear in mind the consequences of what would happen if this is indeed the correct analysis, because it is a viable and possible analysis. Let me point out the reasons why I do not favor favor this analysis. The first is the fact that this 18-month cycle is particularly short, as you can see by the fact that the semicircle is so much lower. The advantage of these semicircles is they represent the wavelength in many ways by their height, and so they provide a very quick visual reference to the wavelength of the cycle in question. And if we measure the number of bars for that 18-month cycle from October of 2021 until October of 2022, you can see there were only 54 weeks or 377 days in that 18-month cycle. That is much too short for an 18-month cycle, in my opinion. Of course, it could be that the 18-month cycle in October of 2021 is incorrectly phased, and it should be more correctly phased in May or June of 2021. But even then, if we measure the number of bars that have elapsed from the March 2020 trough to this trough in October, you can see there were only 930. The average length discovered by Hurst of an 18-month cycle 50 years ago is 546 days, and so two 18-month cycles would be expected to play out over about 1,092 days. If we measure 1,092 days from that trough in March of 2020, you can see that would lead us to expect the next 18-month cycle trough, or I should say the second 18-month cycle trough following the trough in March of 2020, towards the end of March this year. There is the 1,096 days over there. And so we are continuing to watch both of these analyses. What are we expecting to happen now? Let's switch back to my preferred analysis and take a look at some detail. Here we can see the unfolding of the current 20-week cycle, which formed a trough in the middle of October, according to my preferred analysis. The 80-day cycle trough came in exactly as expected. Well, not exactly. I was expecting an 80-day cycle trough around about Christmas time. And of course, Christmas occurred in the weekend following the 80-day cycle trough, which we can now see clearly in our price action. And price has since been bouncing out of that 80-day cycle trough. What is our expectation according to this analysis? Well, let's plot some M shapes. Here is the M shape for the previous 80-day cycle trough, the one that elapsed from the middle of October until the end of December. And we are now expecting the next 80-day cycle. The M shape will be formed by price rising out of the 80-day cycle trough. It needs to come down into a 40-day cycle trough, as you can see, expected pretty much next week. And so fairly soon we are expecting price to come down into a 40-day cycle trough. Then, according to this analysis, we are of course expecting a more bearish 80-day cycle. The reason for that is because the very big cycle trough over here is expected towards the end of February, perhaps early March. And so we would then expect price to bounce out of a 40-day cycle trough. And probably because this is expected to be a bearish 80-day cycle, it will not achieve a new peak. That is fairly important. We are expecting, according to this analysis, an early peak. Then price will, of course, turn down and come down into the big trough expected towards the end of February or early March, that 18-month cycle trough that I have been speaking about. That is our expectation according to this analysis. And so to summarize, we are expecting an early peak, fairly soon probably, a 40-day cycle trough over here, probably forming next week, and then a lower peak, and then a move down into the 18-month cycle trough towards the end of February. Let's take a look at the other analysis and see how it compares. I've zoomed in to show the same period of time, and you can see immediately when we zoom in like this, the difference between the two analyses. The only thing that has actually happened is that the circle and whiskers, the lines that we saw at the foot of the chart in the other analysis over here, have simply been shifted to the left over here and been converted into diamonds because of the fact that this trough in October has been phased as the 18-month cycle trough according to this analysis. What that means is that we still have exactly the same 80-day cycle M shape that forms in this analysis. And we are looking at price bouncing out of an 80-day cycle trough. Here is the 40-day cycle trough, which you can see according to this analysis is expected a bit earlier. It is in fact expected this week as opposed to next week. The reason for that is because the recent average wavelengths of these cycles in this analysis are shorter, because of the fact that the 18-month cycle trough has been found to have already occurred earlier in the price action. And so we would also expect a peak to form and then price to move down into a 40-day cycle trough. It is likely not to be a very strong move down because of the fact that we have so many longer cycles pushing upwards all the way up to the 18-month cycle, based on the assumption that the 18-month cycle trough did occur in October. Then price would bounce out of a 40-day cycle trough, and we would expect price to reach up to a higher peak for the current 80-day cycle because of that bullish pressure. Then we would expect price to come down and still form a trough, according to this analysis, in about the middle of February as opposed to the end of February. I hope that you can see that the two analyses expect very much the same structure in the price movement. The difference is that in this analysis we would expect to see higher peaks forming, whereas in the other analysis we would not expect higher peaks because of the bearish pressure in that analysis. We will soon be able to distinguish between these two analyses and to confirm which one of them is in fact the correct one. I'm going to go back to my preferred analysis now, and let's focus on some Hurst cycles tools to gain greater clarity in terms of what is happening right now. Here we have that analysis with the nest of lows for the 18-month cycle trough still looming ahead of us in March. The Hurst cycle tools of interest here are, of course, the 40-week and the 20-week VTLs, which I've mentioned in previous market updates. The VTL is a valid trend line. It is simply a trend line that connects either troughs or peaks. In this case, the peaks, of course, are being connected by these VTLs, and the trend lines are validated according to some very simple rules on the basis of the Hurst cycles analysis that we have on the chart. The important thing here is that these VTLs are looming just ahead of us, and if price succeeds in crossing these VTLs, it would increase the magnitude of the trough, because when price crosses a VTL, it confirms that a trough of a magnitude 1 degree greater than the cycle upon which the VTL is based has formed in the market. And so, if price crosses above this 40-week VTL, it would confirm that the trough that formed in October of last year was in fact of 1 degree greater than 40-week magnitude. In other words, it would confirm that an 18-month cycle trough has formed in the market. Here are those same VTLs on a daily chart. There you can see the levels over the next few weeks. Those are certainly levels to watch very carefully as price moves up to form the current 80-day cycle peak. Now let's take a look at some FLDs. This is the FLD, or future line of demarcation, for the 20-day cycle. If you've watched any of my previous videos, you will know that I find the price interaction with the FLD a very interesting thing to track. And following a cycle trough of 80-day magnitude, we expect price to cross above the 20-day FLD in what we label an A category interaction. You can see that price really struggled to get above that 20-day FLD. Not really a big surprise, because many traders were on holiday, of course, in the week between Christmas and New Year, and only finally on the 6th of January did price actually get right up above that FLD. And so we have a very messy interaction there with the 20-day cycle FLD. The next interaction following the A category interaction, which didn't really occur, was the B category interaction, where price is expected to find support at the level of the FLD. As you can see, that is pretty much exactly what happened throughout the first week of January. The B category interaction, where price finds support at the level of the 20-day FLD, is expected to occur at about the time that the 20-day cycle trough occurs in the market. There is the circle and whiskers for the 20-day cycle trough, and so it is almost certain that the 20-day cycle trough occurred over here on the 6th of January. As a matter of interest, it hasn't been positioned as a diamond in the analysis, because Sentient Trader, the software that is performing this analysis, is still waiting for confirmation that the 20-day cycle trough really did occur here, as opposed to over here, which is another potential position for that 20-day cycle trough. But in my opinion, that 20-day cycle trough has come in. The next trough that we're looking for is, of course, the 40-day cycle trough, which is expected towards the beginning of next week. We would expect price to come down and cross below the 20-day cycle FLD on its way to forming the 40-day cycle trough. As price forms a peak, which it is expected to do fairly soon, and moves down towards this FLD, we will monitor that price action very carefully. If this preferred analysis is the correct one, we would expect price to cross down below the 20-day cycle FLD and to form a target to the downside for that 40-day cycle trough. If price fails to cross down below the 20-day cycle FLD, that is not a failure of the system. It is a very clear indication that there is a lot of bullishness in this market, which would lead us to consider the other analysis more seriously. Any indication of excess bullishness at this point would certainly favor the idea that the 18-month cycle trough lies behind us instead of ahead of us. There is another FLD that is of great interest to me at the moment, which is the 80-day cycle FLD. That is this cyan-colored line over here. Now, the interaction between price and the 80-day FLD is the same sequence of interactions as we experience between price and the 20-day FLD. And that sequence starts with the formation of a 40-week cycle trough, which according to this analysis occurred in the middle of June last year. The interesting thing when it comes to the 80-day cycle FLD is that we probably need to look at that FLD not on a daily chart, but on a weekly chart. So let me change the time frame of this chart to reflect that. And here we can see very clearly the sequence of interactions. Starting with the 40-week cycle trough that formed in the middle of June, our first interaction would be an A category interaction where price crosses up above the FLD. You can see that over here in this week at the end of June, price came right up to the FLD but actually failed to cross it. It actually crossed the FLD over here, and that is labeled our A category interaction. That crossing of the FLD generated a target up here. I think the target was 42.70, and you can see price achieved that target and exceeded it slightly, which is what we would expect from an A category interaction. The next interaction should occur as the 80-day cycle trough forms in the market, where price is expected to come down and find support at the level of the FLD. Interestingly, that 80-day cycle trough that formed in August was, in my opinion, a straddled trough. A straddled trough is a trough that is very difficult to identify. And if you go back and take a look at the market update videos we were recording at about that time, you can see that we really struggled to identify that 80-day cycle trough. I did suggest in a market update published in about the middle of August, I believe, that the possibility that the 80-day cycle trough had indeed formed over here was alive and well, and in my opinion, that is what happened. And so we had a straddled 80-day cycle trough, and the B and C category interactions, which are expected to occur at that time, were impossible to identify on the chart. In that case, we would identify a B category interaction as price moved down towards the FLD and the C category interaction for the move back up again. The next interaction that occurs is where price crosses down below the FLD, which occurred over here, as you can see, at the beginning of September. That is labeled a D category interaction, and it is the interaction that leads to price moving down into the next longer degree cycle, which is the 20-week cycle. The cycle trough here, you can see, was formed in the middle of October. Now, that price interaction also generated a target to the downside, which was a target of 36.50, about over here. As you can see, that target was achieved and exceeded. When a target to the downside is exceeded, it indicates that there is more bearish pressure than would be expected. That is not unusual, considering that according to this analysis, we are expecting an 18-month cycle trough, of course, that still lies ahead of us. This is the second 40-week cycle in the current 18-month cycle and is expected to be a more bearish-shaped cycle. The next interaction with the 80-day cycle FLD is the E category interaction, as price bounces out of the 20-week cycle trough and reaches up to the 20-week cycle peak. The target that was generated by price crossing the FLD in the E category interaction was a level of 41.50, a level which was almost achieved but not quite by this very dramatic move over here, which I think was news related. I believe there was the release of some CPI figures or some kind of news, and price jumped up, almost reached that target. It failed to quite reach it, and then it dropped down again. The next interaction with the 80-day FLD is then the F category interaction, where price crosses down below the FLD on its way down to this big trough over here. The target that was generated by price crossing below the 80-day FLD at this point over here is a level of about 35.80. Of course, price has not yet reached that level. It has not yet achieved that target. What it has done is turned back up again because of this 80-day cycle trough over here. And it is now at a critical point. As you can see, it is back up at the level of the 80-day cycle FLD. That is why this 80-day cycle FLD is of so much interest. What should happen if this analysis is the correct analysis is that price should find resistance at the level of the 80-day cycle FLD at this point here. In other words, we should see a peak forming right here at about the level of the 80-day cycle FLD. Remember, support and resistance provided by the FLD is approximate rather than very precise, but we would expect some resistance to be found here and for price to come down in what will then be labeled a G and H category interaction on its way down into the next cycle trough. Let's quickly consider the interaction between price and the 80-day cycle FLD if the other analysis, my less preferred analysis, is in fact the correct one. The first thing that you will notice is that the FLD is in a slightly different place. The reason for that is because the FLD is a very simple line. Actually, it's the median price line displaced to the right on your chart by the recent average wavelength of the cycle in question. And the recent average wavelength of the 80-day cycle in this analysis is different to the recent average wavelength in the other analysis, and so the FLD is displaced a different number of bars to the right. The interaction between price and the FLD in this analysis is not nearly as clear, and so I'm not going to go through all of these interactions. This is another reason why I don't particularly favor this analysis. But it is interesting to note that if this analysis is indeed the correct one, and we had the 18-month cycle trough in the middle of October, then this would have been our A category interaction. In other words, the first interaction between price and the FLD following a trough of at least 40-week magnitude. That target is in fact exactly the same as the target that we calculated earlier. It is 41.50, a target which was not quite reached, as I pointed out a moment ago. That is a bit of a worrying sign in terms of this analysis, because you would expect an A category interaction to achieve and exceed its target if price was bouncing out of an 18-month cycle trough. The fact that it failed to do that is a little bit worrying. The next interaction is at about the time of the 80-day cycle trough, where we would expect the 80-day cycle FLD to provide support. As you can see, the FLD distinctly failed to provide support. Price dropped down below the FLD. As mentioned, it has still not achieved its target, which is down here at about 35.80. And so some analysts might suggest that the FLD provided some level of support, but I would struggle to agree with that. Again, price is now at a critical point because it has come back up to this FLD. It could simply be that there is a little bit more bearishness in this market than would be expected, and it is still possible that this analysis is live and well. We might, with the benefit of hindsight, identify this as a B category interaction that slipped a little bit below the FLD, and this would be the C category interaction as price bounces back up above that FLD. The important thing is that we have some levels to watch in order to determine over the next few weeks which of these analyses is the correct one. I do hope that you found this market update useful and interesting. If you have any questions, please join us on our new Hurst Cycles Discord server. And of course, you are very welcome to post your questions in the comments below this video.